Welcome to the Bitcoin Bottom Line. I am joined today by my friend Greg Foss, longtime bond guy, and we're going to geek out about bonds. And we also have a special guest today too, Carpe Noctem. TJ can't join us today, and Carpe is going to be our fact checker. We need fact checks here in Bitcoin. All right, well, let's get started. Greg, how have you been?
It's been an interesting time, Steven, let me tell you. I've never been more busy and I'm supposed to be retired. So that's good. I'm staying relevant.
What I love about you is, you retired a long time ago, but you're so passionate about Bitcoin that you've made a lot of investments in companies, in projects. You've helped out a lot of people out of the kindness of your heart, without making an investment. That's actually, kind of how I met you was.
Exactly. Yeah.
We met advice.
We had an investment where we were co-investors, and so you helped the company. The company became very successful to the extent that Canada now has Bitcoin ETFs, thanks to that company that started the closed-end Bitcoin funds, right? And, it gave the regulators comfort that a spot Bitcoin ETF can work. It won't be manipulated. Yeah, proud to have been part of that project and partner with you in that. So that's how we met.
Yeah, absolutely. That was a lot of fun. And it kind of gave us, really the thought to, at Valkyrie to move into the US and try doing the same thing.
Beautiful. Yeah. Well, congrats on your Bitcoin mining ETF. That's a valuable instrument. There's a lot of smart people in the Bitcoin community. And there's actually the Canadians in the Bitcoin community, I think, actually punch above their weight a little bit from a global perspective. And a lot of them, there's some good mining companies up here and Bitcoin miners specifically. So yeah, nice to see that succeeding. And I love the ticker symbol. So we're going to make it. So let's do it.
Yeah, I love it. I think, last time that we were together in person, we were talking a lot about some of the mining that was happening in Canada. We were kind of geeking out about gas flaring and how that might be a thing. And sure enough, right after we had those conversations and you brought up, Alberta and what was happening up there, that China decided to shut down all of its miners. Miners moved to North America, and guess what they're doing? They're plugging into gas flaring.
Yeah.
How are you seeing that progress in Canada at the moment?
Well, we don't have that much flare gas, to be honest, in Canada. So, the US has more flare. What we have in the company I'm involved with, we actually have 400 megawatts of power that are former peaking plants. They're located right along the TransCanada natural gas pipeline. We will be mining Bitcoin at those plants. In fact, HUD 8 is one of our clients in one of our facilities. So what's happening in Canada, though, that you're seeing is the understanding of how Bitcoin can be used in conjunction. Let's say these peaking plants are going to, there's the 5 or 10% of the time that the grid needs excess power. You mine Bitcoin for 90% of the time, and the 10% of the time when you're being paid in the capacity market. It's a beautiful business model. Yeah. So we have 400 megawatts here. That'll put us in a pretty nice position to compete with a lot of the biggest Bitcoin miners from a power perspective. You're just seeing the certain accounts in Canada embracing it. When I say certain accounts, I mean investing accounts, becoming investors in the Bitcoin mining space, even before they actually own the physical, which is strange, but it's sometimes, how accounts do it. Oh, I'm not really allowed to own Bitcoin, but I'll own a proxy and it's a Bitcoin miner, right? So they get their beta there.
Yeah. Well, what was really interesting was when we were launching ETFs and other types of products, we were thinking about really two different audiences: the intermediary audience, which is obviously, financial advisors and wirehouse platforms,
right,
which I'm familiar with. And then we were thinking about institutions as well. And you're right. Oddly enough, nobody wants to own Bitcoin directly at all, right? Which that's the way I recommend owning Bitcoin, is directly.
Oh yeah. Yeah. Me too.
But, if you're not going to own it directly and you need somebody to handle it for you, you kind of you have to use a few different models. And when we were looking at how to productize Bitcoin rather than holding Bitcoin directly, which is in a product, is another thing that a lot of these guys don't want to do. As we were investigating, we found that there were two different ways to do it. Number one was miners, right? Okay, yeah. I'll own the miners, but even that is sort of niche for a lot of the wirehouses. the ETF that we launched in December is actually way more suitable for those people. And that was companies that hold Bitcoin on their balance sheet. They want the correlation to Bitcoin, but they don't want the miners. They don't want to hold Bitcoin.
Interesting. Okay.
Yeah. And I think a lot of these shops are just a little too far off to still get there. You know, there's Bitcoin.
But it's coming, right? It's coming because, you know, here's the thing. You saw that Fidelity report. You know, it's a great report for any listeners who haven't read it. You know, it basically is to summarize. There's Bitcoin, and then there's, you know, I don't know if you swear on your show, but you'll have to edit this. There's Bitcoin, and then there's shitcoins is basically the conclusion. But Fidelity thinks that by 2026, the Bitcoin asset class will be a sleeve in every landscape. And when Fidelity says that, everyone's got to be thinking that, oh boy, Fidelity is one of the largest asset managers in the world. And if they offer it, I better turn around and get it in my own product line too, right? So I think that's, it's coming. But it's funny, you get an account like, you know, the Canadian accounts, big accounts like Ontario Teachers, they'll buy an investment in FTX, and they'll buy an investment in Celsius Network, but God forbid they should actually own physical Bitcoin, right? Which is just like, you know, they're sort of doing it ass backwards, but that's not the first time that's happened. I started my career as a high yield bond trader in Canada. And the funniest thing is when I would call an account and say, hey, you know, you own $700 million, literally, you own $700 million of Rogers Communications stock. How about you buy some of their new issue bonds at a 10% coupon? And they go, no, I can't own the bonds because they're junk. And I'm like, oh, hold on a second. You own the subordinate claim equity. You own 700 million of it, and you won't even buy the bonds, which are a senior claim, and pay a 10% coupon. And anyway, you know, you go through that long enough, you end up banging your head against the wall. But, you know, 20 years ago, nobody in Canada, well, let's say 30 years ago, nobody in Canada owned high yield bonds. Yeah. And now every asset manager has a high yield bond sleeve. The same thing's going to happen with Bitcoin. Yeah. It'll happen faster, but it's going to happen.
Yeah. Well, you know, I remember having to deal with that, you know, here in the US with institutional accounts. I traded some bonds, and I was also a portfolio manager for fixed income for large institutions. And life insurance is another area that you look at and you're like, okay, well, number one, they're not going to hold Bitcoin directly. They can't.
Okay.
But when it comes to junk bonds, life insurance companies are really governed by the rating agencies for, you know, and the rating agencies determine how much capital they have to reserve against each one of their investments. So, you know, that's why they're so filled up with investment grade bonds and treasuries, even though from a real perspective, it's a negative yield at the moment, because junk bonds are really anywhere between an NAIC 4 to an NAIC 6, which is the lowest ratings you can get. And NAIC 6 has like a 30% capital charge against it.
Right.
And from their perspective, it's, okay, I can hold a junk bond, or I could have the same capital reserve as an equity, and my expected return on equity is higher than a junk bond, so I might as well buy the equity. Or even better, private equity, right? They'd rather own private equity than a lot of junk bonds. So it took a long time to get them over some of those issues. And one of the interesting ways we got around a lot of it was by doing, you know, structured credit.
Structured product, structured product for sure.
Yeah, and you know, essentially, you know, wrap up a CLO and then sell the higher rated tranche. It's still a junk bond.
Yes, sir. It sure is. Yes, sir. It still is.
Yeah, junk bond's a junk bond. Or as we found out during the financial crisis, you know, a bad mortgage is still a bad mortgage, even if it's packaged up nicely into a CDO.
Wow. Well, don't forget though, in 2007, the Fed did say that the subprime mortgage crisis was largely contained. So don't worry, everything was fine in 2007, according to the Fed. We're walking down a similar path right now. These clowns have no clue what they're doing. So that's.
Well, it's funny because Josh and I, we talk about this a lot, right? You know, what is the Fed going to do, and what's the Fed thinking, right? And the problem with the Fed is they're very academic. They've never traded risk, and they're always very backward looking. They're waiting for data from, you know, months ago or a year ago to make decisions about things that they can do a month from now that will affect the economy a year to 3 years from now.
It's crazy. Yeah. It's not an easy job, but the worst part of it is, I believe, a true lack of understanding about how the markets work. And you can job own all you want, but at the end of the day, when volatility exceeds 30% annualized in the equity market, so the VIX being over 30, that implies daily moves of plus or minus 2% average daily volatility. New issue markets and everything close when vol is over 30%. And vol is creeping up. And if new issue markets close, access to capital closes and growth stops, and you're not going to be able to hike 8 times. Okay. You can never be 100% certain, but this is just not going to happen. Yet they're job owning the market. They're leaking it out through Goldman Sachs, as if Goldman, because it's coming from Goldman. Well, it's going to happen, right? Anyway, it's a difficult situation they're in. I predict that a taper tantrum happens probably after it as little as 2 rate hikes. Then it's okay. They walk it back.
Well, this is funny because I was actually hoping that we would have different views on this, but we don't.
Okay. I hadn't heard your view, but I can't imagine that, I couldn't imagine that you thought different than that. Anyone who's sat in a risk chair knows that, at first it starts in the credit markets, and the credit guys use the equity as the whipping boy. Then equity markets start falling apart. And given that there's no returns left in bonds, so everybody's pension is now relying almost entirely on equities as a performance generator. Yeah. If pension funds go to the underfunded status, there's going to be a lot of upset pensioners out there. There'll be an upset president, and there'll be pressure to skate the equity markets back on sides. So, we'll have to see how this goes. But I'm just sold to you. You think 8, I think 2. And let's figure out where it really is going to be.
Yeah, I mean, I was saying back in, I don't know, between November and January, for about that period, I was saying that we would have 1 rate hike.
Attaboy, interesting.
Exactly 1.
Okay.
Because once that first rate hike hits and people say, oh, they're actually for real right now.
Yeah.
And
Steven, that's crazy cool, because in January, it was the first month in the history of the NASDAQ that the long bond and the NASDAQ were both down more than 2% in the month. The NASDAQ was down 15 something, if I remember correctly, in January, and the long bond was down 8 points or 8% in the month of January. That's used to be able to rely on the long bonds as your dampening, right? When equities went down, bond prices went up, and the 2 Ray Dalio built his entire business on in the risk parity. Well, it doesn't work when interest rates are 1% or lower. Okay. There is no cushion in bonds. They don't, in rational places, they don't trade through 0. Irrational places like Europe, they do, but that's okay. There is no protection in bonds right now. And so the long bond is now off 20 points from its high. That's $20. I need people to understand what 20 bond points are. That's $20 or 20%. And if the coupon was 2%, you've lost 10 years of return in 1 month of bond price changes. Okay. That's not that safe. And don't worry, I own bonds. They're safe. Oh yeah. Good on you. You failed mathematics, you knucklehead.
Right. Well, but if I just hold on to them till it matures, then I'm okay,
it's called an opportunity cost. And you don't, you just, you can tell your clients, well, I'm going to be fine. I'll be paid out in 28 years. They're going to look at you and say, you're not holding my money for 28 years. Give me my money back now. Yeah. And that's the reality. So life insurance portfolios that have matched assets and liabilities, that's fine. But for a regular mutual fund, for a regular investor.
I mean, pensions, same thing, right? I mean, they run off of LDI. So yeah, there's a little bit of a buy and hold, but at the same time, they need that return every year.
Oh, they 100%, because look what you need right now in the 60-40 portfolio. Let's just say you're 40%, which is your bonds. Is it fair to say an average return or an average coupon on all the bonds, whether they're treasuries, munis, junk bonds, is a 3% yield. Okay. 3% times 40% is 1.2% is what you're getting on the 40% of your portfolio. You're earning 1.2% there, excluding defaults. Now, if you have a hurdle rate like CalPERS, of which is 7.5%, that means you need on your 60% equity portfolio to earn the difference between 7.5% and 1.2%. So that's, what is that? 6.3%. 6.3% out of a 60% equity portfolio means the equities have to go up 10% annually forever in order for you to make a blended return of your 7.5% hurdle.
Right.
Before defaults. Ain't going to happen, people. So what did CalPERS do? Oh, we're going to fix this. We're going to use leverage.
Right.
What could possibly go wrong? What could possibly go wrong? What
Nothing
a bunch of clowns.
Nothing.
Yeah.
Leverage is
Yeah.
perfectly safe.
Holy
correctly,
moly.
right?
Holy moly. And yet they won't buy Bitcoin because, that's risky.
Well, the
So
other
looking
thing
at NASDAQ. Sorry.
Oh, sorry. Say that again, Josh.
No, I was just going to say, looking at NASDAQ against Bitcoin, Bitcoin's actually down. The decline is smaller than NASDAQ since year to date, and bonds are
So
actually
this is
negative.
where I think things eventually go to, Josh. And we talked about this. Bitcoin will be a long volatility asset. When people finally do their homework, they'll understand that Bitcoin is insurance. It is effectively being short credit. And when you are short credit, you are long volatility. And you love being long volatility, because how does volatility trade, right, Steven? You take the staircase down, So, it bounces around at 14% annualized, and then the world unravels, takes the elevator up, hits 80%. You want to be long vol when things go from 14% to 80%. Trust me.
Yeah.
And that's why Bitcoin is so beautiful. But it takes an education process, because right now all the machines, the computers programmed by humans, are trading Bitcoin against equities and trying to correlate those two things. And it's working to an extent, but over time, they're going to be so inverted, there'll be a face-ripping rally for all these knuckleheads that are short Bitcoin against long equities. It's just ridiculous.
Well, and this is something we've talked about, right? I've always, the way that I've always, I hold some Bitcoin and I trade some Bitcoin. And the way that I trade Bitcoin and other markets is I look for the short-term correlations. Back in 2017, it was the Kospi. If you were watching closely, in 2018, it was Shanghai Index. You literally just watch the Shanghai Index overnight and trade Bitcoin the next day.
Interesting.
Buy, sell. It was, and it's been a lot more correlated in this last year to equities, mostly to the NASDAQ. But here's where I think it's going to go. I think that we're going to start trading a little bit more closely to commodities.
Interesting.
Yeah.
Okay.
I think we're going to have a rally in commodities. Anything that is a rare asset. There's not enough commodities to go around right now. There's supply chain issues. You've got these truckers in Canada that are trying to shut everything down. Shame on them. You've got but you don't have enough things coming out of the ground.
Right.
Things shipping to places, and that's what's calling.
Was it a Wall Street Journal article, or the title? I remember the title. I can't remember where I read it, but the title basically said, "You name it, we're out of it." And it was a commodity guy, and he said, "You need it. You need steel. You need nickel. You need platinum. You need this. We don't have it." Okay, so it's basically that's the reality. Sure.
Lumber, coffee, wheat, cotton, all of it, right?
Yeah.
I take oil and gold out of those categories, because we can control oil, whether it's or OPEC, but I don't think there's going to be enough Bitcoin.
I know there's not going to be enough Bitcoin. Okay. I mean, that's the simple math of it. There is not going to be enough Bitcoin, and it's going to become game theory, right? Because everyone in the world is at the mercy of the Fed, and everybody, all other central bankers included, have what they call the Fed put. The Fed will rescue the world. Right. And it was a term that was coined when Alan Greenspan came in, and rumor was when equity markets were down by 20%, the Fed would come in and rescue equity markets. So the Fed put. My interesting thing is, what happens if the Fed put doesn't work? Because there will be a time when the Fed tries to rescue the markets and the markets are like, no, sir, we've seen how this ends. We've seen it every single time. So the other central banks in the world are going to have to be like, what if the Fed put doesn't work? What can we own? And my argument is you own Bitcoin.
Right.
And then you start a games race or an arms race. One central bank buys some Bitcoin. And then other central banks are like, what the heck's going on here? I better get some too, right? And so it's a put on the Fed put. Bitcoin is a put on the Fed put. And that makes me pretty excited because then you can explain why Bitcoin is the best asymmetric return opportunity I've ever seen in 30 years of managing risk. And you weight it accordingly.
Yeah. Well, going back to the Fed, let's talk about that for a moment, because I think what's going to happen is going to be really interesting. I shared that I thought there would be one rate hike, and that was my opinion up through January. I think we're subject to, depending on what happens in markets and policies, we're allowed to change, and that's what we're supposed to do.
Yes, sir.
But I thought that we would end tapering in March. There'd be an announcement in March. There would be a rate hike in May, because the Fed likes markets to be
prepared.
They like all the risks to be priced in before they do anything. Right. I mean, that's how they work. They don't want disruptions, especially in a midterm election year. Right. And then there would be one rate hike, and then people would actually think that the Fed was for real, and then they would stop. Well, as you said it, they've leaked information through a lot of sources, and you've got, there's going to be 7 rate hikes. There's going to be 100 basis point hike all at once. There's going to be a 50 basis point hike all at once in March, and they're letting the markets price that in. I think they're going to try to do something in March.
I agree.
But I think that there will be 2, maybe 3. So I'm probably more closer with you now. Now that a lot of this is being priced in, and then after 2 or 3, the market's not going to be able to take it. I mean,
well, they won't.
You traded junk bonds.
Yeah. So what happens, right? Like, I mean, what happens here? This is what happens, and why credit spreads are blowing out right now. Credit spreads are blowing out because, first of all, there's been a sell-off in the equity markets. Therefore, the equity cushion that is subordinate to the credit, that equity cushion has been reduced by 10%. So therefore, spreads need to widen a bit to account for the lower equity cushion. But if the yield curve inverts, it has successfully called 6 of the last 6 recessions. Okay, an inverted yield curve will imply recession. And you don't want to own credit going into a recession. So credit spreads are going to have to widen more. And when credit spreads widen more, the cascade hits downwards and smacks the equity guys. And they don't understand what's going on. They get run over because they're just equity gooks. Okay. And at the end of the day, the credit markets control everything. And that's where the Fed will have to stop, because yield spreads or credit spreads are going to be widening. Equity markets are going to be getting destroyed. And if the Fed is hiking into a recession, that's disaster. Okay.
Right.
And credit sniffs that out, prices the increased default expectations accordingly. And then everything goes to heck in a handbasket. And they will stop. The Fed will stop.
Well, let's talk about what's precisely happening with the companies that are issuing junk bonds, right?
Yeah.
And I keep calling them junk bonds, but
that's all good. Junk bonds, super junk equity. No. If you call them a junk bond, which is a pejorative, make sure you call the equity of the same company super junk equity, right?
Exactly.
And we have 5 minutes left, but yeah, they're junk bonds.
We might have to go longer. But what I want to talk about here is, most of the people that are watching or listening, they don't know that junk bonds are usually priced to 5-year, right?
Correct.
And 5-year treasuries are almost 2%. And
that's right. They're very flat between 5s and 10s, right? 5s and 10s are almost exactly the same yield. There's maybe 10 basis points spread in that curve.
And the 5 years jumped to 2% because there's an expectation now, it's being priced in, that we're going to have, 7 rate hikes, whatever it is, 6 or 7.
Right.
And that's not entirely priced in, but
it's not, but it's getting there. Yeah.
So if you have the 5-year at 2, right? And the way that junk bonds work, or the companies that issue high yield bonds work is they typically issue, shorter paper than investment grade companies. It's usually anywhere between 2 and 5 year paper, sometimes 7 if they're lucky, and they never just mature because they can't afford to pay the principal. They always
roll it. Debt always rolls.
They always
Debt
roll it
rolls.
a year in advance, right?
Yeah.
A year in advance of maturity,
Yeah.
or callability.
Yeah.
And right now, if the 5 years at 2%, a lot of these companies can't pay their debt service on that new rate.
So there you go. And you have to widen yield spreads or widen credit spreads to accommodate or reward the investor for the increased default probability. Higher interest rates mean higher interest service or debt service costs, mean lower credit quality, mean wider yield spreads, everything else being equal. And when yield spreads widen, that's when the Fed needs to get concerned. And remember, in the COVID crisis, when the Fed bought junk bonds, they were buying it because of 4 different credits that cumulatively, these 4 credits have more debt than the entire high yield bond market. And these were right on the cusp of being downgraded. Those 4 credits are AT&T, General Motors, Ford, and General Electric, all BBB companies that are right on the cusp of being downgraded. If they got downgraded, the high yield market would have been inundated with supply and everything would have stopped. So the Fed said, we'll be able to buy junk bonds or high yield bonds. Well, get ready, Fed. You're going to have to do the same thing again. What does that mean? They get snuffed out. There's not 8 interest rate hikes coming.
Well,
and
it creates a death spiral.
It is. That's all it is.
Yep. Because the risk-free rate goes higher.
Yeah.
Spreads blow out.
Yeah.
Then they have to go higher. Then spreads blow out even more. I mean, it's just it'll just keep going until you have defaults of 12 to 15%, which they're not going to let that happen.
They cannot because, well, first of all, high yield is still low yield because it yields about 5%. And if you had 15% defaults at an average recovery rate of 40 cents on the dollar, that means 15%. That means you're losing 9%, right? That's 60% loss on 15%. And the market's yielding 5% and defaults are going to cost you 9%. Mm-hmm. High yield bonds are the worst investment I've seen in my 30 years of managing risk. And all bonds are horrible, except volcano bonds. We could go there some other day. But
historically, high yield bonds have always been the best investment.
They have when they were actually high yield. Because when I started, they were double-digit yields. They were 14% yields in high yield because that was high yield. And by the way, inflation wasn't running at 7.5%. So there's just no reason to own bonds unless you failed mathematics. So basically, learn math. Sell your bonds, buy Bitcoin. I'll see you in Miami.
Awesome.
And looking at one last thing, we're looking at rates and CPI globally. The U.S. has the highest real central bank rate, aside from Turkey and Argentina, who are at 35 and 11% respectively.
Yeah, those 2 are defaulted, right? So Argentina has defaulted 4 times in my career. There's never been a 30-year bond that's matured in my lifetime because Argentina has actually defaulted 4 times. So whoever buys a 30-year Argentinian bond, you better start studying history because you certainly failed math. And the worst part of it is Argentina is a G20 country. So, it's going to happen. And I'm in Canada. I'm a proud Canadian. Canada will default 10 years before the USA defaults. And we're G7. Okay. Be careful. Own Bitcoin.
Hey, thanks for joining the Bitcoin Bottom Line.
It's been a blast. I look forward to meeting CJ and nice meeting you guys and great work, Valkyrie. Proud of you guys.
Hey, thanks so much, Greg. Yeah, we'll do this again with CJ here in a couple of months.
I look forward to it. Okay, thanks for having me, guys.
Thank you.
Take care.